Hello and welcome to our new series, The Asian Tigers, where we are talking to a lot of fund managers and experts from Singapore and Hong Kong. My guest today on the show is a very old emerging market hand. He was a fund manager for many years at Goldman Sachs and now is the founder of his own company, White Oak Capital, Prashant Khemka. Prashant, pleasure to have you with me today. Thank you, Dean. It's a pleasure to be here. Thanks. So it's been a great year for our market. As we come to the close, how does it feel? Is it looking like risk-reward is still on the balance, or are you getting a little conservative, or does the market appear toppish?
I'm generally on the positive side, and so I am right now as well. I'm quite constructive. I think we are at the cusp of a earnings acceleration in India. For a variety of reasons, it's been pushed back over the last 2-3 years, but this time it's for real, in my view. And so it's too early to get worried. I think we might be at a point in multiples where it's hard to get much re-rating upwards, but we should get strong earnings growth from here, and that should be reflected in returns going forward.
This earnings growth that you're talking about, next couple of quarters we have a very favorable base effect. Certainly. Beyond that, are you confident that this will follow through? Because reading some of the estimates for FY19 and FY20, people are talking about 20% earnings growth again. Do you think it'll come through?
I do think at some point we would have 20+% earnings growth. Next 12 months, as you mentioned, are easier comps. Gut feel is that it would be sustainable. See, over the last 8 to 10 years, we've had mid-single-digit earnings growth, while longer-term trend has been 13 to 15% earnings growth. So 20+% in that context is not that dramatic. 5% during bad time of the cycle, 20+ during good time of the cycle, averaging out to about 13-odd%, which is what the longer-term nominal GDP growth rate has been as well. So basically, corporates in India are capturing the nominal GDP growth plus a point or two.
Now, as you said, there is skepticism because, every year we keep hoping it'll happen, it does not.
Yes.
What makes you, beyond the gut feel, what makes you confident that this time you won't be disappointed?
So you're right, there's been a bit of a crying wolf syndrome in that. And hence, I do believe, while the stated expectations are 20% or whatever, if we do get 20%, it would be a big positive surprise. The whisper expectation, if you will, people would be pretty happy if you get even low teens. Now, what makes me more confident this time? So I think a couple of things. Over the last few years, there has been a bit of a deflationary impact of global commodities, global cyclicals, which has stabilized now. And while commodities might be a small component of the market, it has impact on a much larger spectrum of companies. So poor commodity environment hits industrials pretty hard. There isn't demand for a lot of industrial equipment. It hits many of the banks pretty hard, as we've seen in India. So as commodity cycle stabilizes, it again has impact well beyond the commodity stocks or commodity companies themselves. So that is one key aspect of earnings recovery, if you will, which is that the downside hit of commodity chain is absent, should be absent going forward unless there's a big leg down in commodities globally. So that is one. Secondly, we've had several poor monsoons prior to the last one. If you recollect last year this time, we were recovering in terms of corporate earnings. We were on our way for December 2016 to be first double-digit earnings growth on the back of a decent monsoon last year. However, as we all know, demonetization stalled that recovery or delayed that recovery. So I think after last 4 years of impact from demonetization, which we would anniversary going forward, that impact is also washed out. So these two coupled together itself should prompt a decent recovery. And beyond that, I think GST is very important for corporate earnings over and beyond the impact on economic growth.
How do you position yourself to play this now? Because what you're saying is that commodities will help earnings, but it may also take away a little bit from the margins of some of the commodity consumers. Do the horses need to change for this course for the next couple of years from what has been the outperforming lot over the last year or two?
So there are a couple of things. Yes, corporate earnings would be helped by this, but that's not necessarily to say that the stocks would also be of the same sectors do better. Because many of these are already, or more than already, might be reflecting. Let's take the example of GST. I think in the consumer durable space, some of the names are more than adequately reflecting the shift from GST. Also, I think when you think of commodities, including the positive impact of recap, I do think that government-owned banks are more than adequately reflecting the positive environment, credit environment for those. So it's not necessary that from a stock picking perspective, the most obvious areas would be where you want to be positioned. I think to your question, which sectors, I'm very positive, first time in my life, on telecom sector, in Indian telecom sector. 10 years ago or so, when I moved to India to start the India business, telecom sector had very high returns on capital, but they were unsustainable looking forward because everyone and their brother was rushing in. Now, where we stand today, all those guys are rushing out. They are either surrendering themselves or killing themselves.
So we are at the bottom.
In telecoms, definitely, I see a massive rebound in earnings in telecom sector. Selective private financials remain as ever, very well positioned for the whole cycle and beyond.
When you say financials, do you mean banks or NBFCs too?
I would say high asset quality banks, as well as some of the high asset quality NBFCs, though there is more froth in NBFC in my view. But high asset quality financials. I think the first $1 trillion company in India would be a bank.
Private bank.
It may be some decades away, but would very likely be private bank.
You're not saying it will be HDFC Bank?
I can't say that. There is more than one contender, I think.
There is? Wow.
But and there could be that the first two companies in that club would be private banks. I can't name specific companies, but sure, these, are of the caliber. So India is the only place where you have high teens credit growth, and private sector, well-run private sector banks can grow in the 20s. And there is high barrier to entry. A very limited number of banks.
But hold that thought. You said high asset quality. Does that mean you're still ruling out the corporate banks in India? You would still not be comfortable owning them?
I would. I think from a market cycle, full business cycle perspective, I haven't seen any sign of a structural change in their DNA or culture, if you will. Until I see that, would be difficult to believe they would not repeat some of the same mistakes in the next cycle.
You speak of public sector or even the private sector corporate banks?
So not every one of them, but more broadly, I would put both government as well as private sector in that camp.
What would convince you that valuations are attractive enough to get into that cycle? Because if a capex cycle plays out, some of the corporate banks from where they are today in terms of valuations might still have a nice business cycle to play.
Absolutely.
But you're saying that after recapitalization in 1 day or 2 days, we actually covered that distance?
I think we covered a lot of distance. 30% return in 1 day is like 3 years worth of return. You can argue last 3 years they didn't do anything. My challenge is what has changed to suggest that in the next cycle, they would not repeat the same mistakes again.
They will.
And if they will, there is no reason for a sustained re-rating of multiples. You can catch those bounces every now and then, but then you endure the pain for a long period to catch that bounce.
But let me ask you a little bit more about financials, since you are clearly interested in that space. Which pocket of it attracts you more? I mean, there are discrete pockets. Somebody's playing financialization of savings, somebody's playing vehicle finance, somebody's playing consumer lending. What's the really attractive bit there?
Certainly. I think rather than focusing on any particular segment, I think my focus has always been on financial companies which price the credit risk appropriately and extract more than commensurate return or profits from that. To answer more specifically, at this point, I think there is a lot of risk of heated competition in metro-centric or urban-centric, housing finance or LAP finance kind of. In my building where I stay itself, there are more than half a dozen people who applied for HFC license, NBFC license to do LAP kind of product, an HFC. Reminiscent of 2007 when everyone was opening a real estate company, or 2000 when everyone was opening a .com company. I think there is tremendous amount of new competition in that segment. I'll be particularly careful.
Of valuations or generally the space being too crowded?
Will get very competitive. And so the return or profit metrics which people are extrapolating based on current housing finance companies would not be realizable going forward. Similar to how people were extrapolating in 2007 the then existing profitability of the leading telecom companies to play out for the 10 new entrants that were coming in. So I think profitability would not be delivered in this segment, and hence the multiples that some of these are getting would not hold up over time.
What about the companies which are financial market facing, asset management companies, insurance companies, brokers? What is your stance on these kind of names?
Certainly. Again, would be more selective. I won't say blanket that they are expensive or they're cheap. Certainly there is an element of exposure to capital markets, but that is not to be held against them. And there are selectively opportunities in that segment, particularly in life insurance as well, while some of them have not given strong returns after listings. But I think there are going to be big winners and some losers as well from that space. And again, my focus would be on the better and best. And in financials, I think the on the surface valuations can be very misleading in terms of price to book and all.